Hello, everybody, and welcome to the Middle Class Investor this week. This is Seth Martin, and you can see the S&P 500 had another up week. So out of the 1, 2, 3, 4, 5, 6, 7, 8 weeks, we've had 6 up weeks, and really this was an up week also. And so we've had a very strong rally, much like this one over here, although this one was a little shorter. And we're right here up against this resistance line that I drew a while back. I actually pierced it a little bit, but I don't know if you remember, but when we talked about support and resistance, we talked about support and resistance being a zone. So this line we don't consider this line a hard and fast line. It's always interesting when it just touches the line and reverses, or comes down and touches a line and reverses. But these lines are zones of support or resistance, not, physical walls where price has to stop. It's just a place where we can say probably price will stop and return to the downside. Now, I might just show you a shorter term chart here in a minute, but suffice it to say that on the shorter term charts, the S&P 500, this trend is running out of steam. So I'm expecting this to begin reversing next week, and I actually, we talked about it last time. Let me just recap that real quick. We talked about whether or not, whoops, sorry about that. Let's see if we can get this to lock in here. There we go. We talked about whether I had this zone here drawn, and we were talking about whether or not, the market would pull back and then come up to the line. And of course, that's what it did. But we also said that it could just make a candle like this and start going down from here. Of course, it did the other thing, right? It did. It pulled back and then made a new recovery high. So, when you start getting really close to these areas of support and resistance, this is where you really have to pay attention, and your rules really matter. So if you're expecting it to come up here and bounce down, well then, a rule like, if this is the high day or the high week, and I'm looking for a close below the high week. So, and then the next week I would make a decision about entering the market, let's say. But you can see if that's your thesis, it never would have happened, right? Because we didn't close below this low right here. And because we didn't close below this low, you wouldn't have taken a short position here. You wouldn't take a long either, because you don't want to take a long position at the toward the end of a trend. You want to take a long, it's obvious now, right? But you want to take a long, somewhere in this region. Anyway, that's. I just wanted to recap what we said, because we were talking about this past week. We were talking about prepare for some selling for the next 3 to 4 weeks, and of course we didn't get that yet. But I think the caution remains: prepare for some selling the next 3 to 4 weeks. Given the these previous moves, this move here and this move here, I think the likely scenario is that this market is topping. The good thing about it is it's topping, pretty darn slowly. I mean, you've got if we zoom out here a little bit, and then we zoom back in on just this, you can see that we've got this kind of a rounded topping action. Now, obviously, at some point it accelerates, right? Which is what we're trying to avoid. these drops in here are 10, 12%, but this next drop could be quite significant. And so let's just talk about that for a second, because we were looking at a different, potentially another scenario, and I think it's still viable. I think it's worth mentioning. I think it's a little less probable, but it's still very much a possibility that we have to account for. But you could kind of see, a consolidation here with the Dow. Of course, it kind of jumped up out of this line, which is okay. Again, this is a zone. It held pretty tight right here, but it doesn't have to hold as tight in other places. But I think what you could see is kind of an alternative. You could see the Dow kind of move down into this zone and then reverse and really go to maybe a new all-time high. And I think this is something that we have to prepare for. So what we want to do is we really want to, next time the market comes down into this zone right here, we really want to pay attention to what happens here. Does it chop around and then bounce, or does it kind of pause and then fall through? And that's why I like to try to, wait for a close below the high week in this case. So next week, if we get a candle that looks like this, then you would want to start preparing for a move down into this area. And then when it gets here, then we'd want to do the same. And if we got a close above, we'd want to get in and go ahead and take this ride up to this area here. So needless to say, we'll be watching closely when that happens to see what the market behavior is right here. But the S&P is telling a very different story. You do have some lower, you got a high, a low, a lower high, a lower low, a lower high, potentially a lower high. And so the S&P is telling the story of downtrend, as is the Wilshire 5000. Let me zoom in on this and take some of this stuff away. So same thing with the Wilshire, this is a downward step. Now, this might be bad data. In fact, let's just let's go here and put it in here and see if that data, whoa, that's crazy looking. Well, maybe not. Maybe that's not bad data. That's very unusual to happen, and it's most likely bad data. So let's not look at the Wilshire, but very strange. It's usually not. Usually don't see that kind of stuff. At least not on a weekly chart. You might see it on an intraday chart, but not on a weekly chart. So let's not look at the Wilshire, because I don't know if that's real data or not. But the S&P 500 is very a diverse index. If you were to look at, of course, that's not the index. That's the SPY. There's the index. If you were to look at the NASDAQ composite, it's also a very diverse index. You can see this rounding kind of top as well. So let me go back to the S&P 500, because I want to look at a shorter term chart. Let's look at like a 60-day chart, and you can see this move up here, and this is pretty characteristic of a like a counter trend rally. So you got this kind of overlapping action, and then the market narrows as buyers and sellers start to agree more and more about what fair price is, and then you typically get a rollover. And you can see these moves. Let me see if I can demonstrate this a little bit. You can see these moves. These spikes up after pullbacks. They tend to get shorter and shorter. See how those are getting shorter and shorter? And when they do that, that's the market running out of steam. So a lot of times you can look for this in these pullbacks. You might have to go to a shorter term chart, but as these run-ups get shorter and shorter, new buying pressure starts to wane, and the market just kind of starts to fall under its own weight. And that's pretty much what happens over and over again. So what you'll always see is these moves off really stretched bottoms. That's why you get the most bang for your buck trying to pick the bottom, which there's a lot of people do. They come in, a lot of institutional money comes in here and they say, hey, this is a good price, and they buy it. In fact, every pullback has to be met with somebody to come in and buy. And a lot of times that's big institutional money going, hey, these are good prices, I'm going to be a buyer there. But as you start to move higher and higher in the move, less and less, fewer and fewer of those buyers show up to push the market to new highs. And so you start to run out of steam, and then that causes the market to roll over. So I would say we're very close. It's possible you get a small little down and then another high, but what's more likely is maybe the market on Monday maybe gaps up a little bit from here and then fails and starts to come down. So we'll watch for that to happen. And like I said, the key is what's it going to look like when it gets down into these previous lows. If it breaks these, then Katie bar the door. We're looking for zones down in this area, which are pretty good sized losses. So that's, again, just to remind everybody, that's why I started doing this YouTube channel, is just to help people kind of make a decision, not decide for you, but help you make a decision on what to do with your 401k if selling really starts to pick up and we start, the trend changes and so on and so forth. What we don't want to do is have you live through another 2008 and not be sleeping at night or whatever. All right, so let's look at the 10-year Treasury. As you know, that's something I've been focused on quite a bit. It continues to confound. And I would say at this point, we're probably going to make a new low below this low. So let's zoom in on that and talk about it just for a second. I think we're likely to come back into an area below this low right here and make a new low. Now, it won't be a new all-time low. It'll just be a new pullback low. And, if the thesis is correct, we should see a pretty good bounce from there, and you should see interest rates take off. But I got to tell you, it's surprising that this one right here. I'm surprised. I don't know if anybody else is surprised, but I'm surprised that this one low right here, this range bar right here, I'm surprised that didn't just reverse the market, because this is an extraordinary move, and it happened at the bottom of this downtrend, and all signs pointed really to higher highs from here. Now, what could be the case is this could be a smaller degree first move off the bottom, okay? And then this could be the first pullback of a smaller degree move. And then this move is the next big move, okay? That's possible. I don't know if everybody's following me on that, but we've talked about this before, where I can't seem to get rid of there we go. I can't get out of this mode. But we've talked about before that that if this is an important bottom, in other words, this is a very large degree important bottom, and then this is the first move, and this is the first pullback, then interest rates could really start to go much higher from here. And it could be that this pullback ended right here. Okay, so we've got a situation where, let's see if I can't get all that data in there, but again, this would be the first move. This is the first pullback, kind of chopping back. And then let's say this is the new important bottom. Okay, so this was the first move, first pullback, and then we have an intermediate. So think of this as like a big cycle low, and maybe this is an intermediate low. Now, this is all just speculation. Okay, I don't really know. There's no way to know. But let's say this low is the low of the cycle pullback. Okay, and then we have a smaller intermediate move up, and either this low or you get maybe a new low down into this area. Let's say this now is the first pullback on the first intermediate move up, and then which means this move will be big, which will be just a small part of the overall big move from this pullback. I know that's confusing, but that's kind of how the market works. We've talked about it before, that it's a fractal. The market fractals. It makes larger and larger degree moves. That's why it's so important to know where you are in these really long-term cycle trends, is because if you're in a minor or an intermediate term pullback, no big deal. You can survive that. But if you're in a cycle or like a grand cycle pullback, your 401k is not going to survive that. You're going to lose tons of money. It's going to take years to get it back, maybe decades. So that's the purpose of this YouTube channel, is to help people stay out of that huge cycle move. Because you can lose lots of money and it's hard to recover from. Now, some people say, well, golly, that's not very likely. You're right. It's not very common. So let me just show you what I'm talking about. Let's look at all data. And this goes back, you can see this is your 1929 crash right here. And unfortunately, this system doesn't go back, but there are people that have studied the market back to this point. And this was a huge correction, which started a whole new huge cycle. And if this is a whole new huge cycle, which a lot of people that study the market say it is, we could actually, this market, before it's all said and done, could pull back into, at a minimum, this region right here around this blue square. So what is this? This is, that's around 1100 or so on the S&P, and more likely a pullback below the 2008 low, which is this low right in here. But at a minimum, we're talking about a pullback into here, and at a maximum, we're talking about a pullback into this 600, 500 area on the S&P 500. Well, that's a huge move. That's a move that will absolutely wreck your 401k. So, and in fact, let's just look. Let's see if we can get that on the screen here. I can't even get. Let me try 20 years worth of data, and I'll just zoom in. Yeah, well, let me just make that measurement here. Let's say we did get a pullback just from right where we are right now. From right where we are right now down to, let's call it, what is that? 562. That's almost a 73% loss in your 401k if you rode that all the way to the bottom. Now, we've talked about this before. The market takes the stairs up and the elevator down. So what you can see is it takes a long time to get, you had this massive loss, and it takes a long time to get it back and then start getting in the positive area again. So we want to minimize our exposure to the elevator down. That's the purpose of this YouTube channel. And you can really see here we're getting a kind of a rounded kind of top, which is not as common. You can see this is kind of a smaller degree rounded top, but this was more spiky, right? It kind of ran up and then sold off. But where we are right now, this is when you see these longer tops like this take place, that just means that the bear market's going to last that much longer, because people are giving up slowly and saying, yeah, there's no more growth in this market. And what happens as they give up slowly, you get this kind of rounded top that takes a year and a half, 2 years to resolve itself. So anyway, I kind of got off tangent there a little bit, but suffice it to say, we've got some serious potential for some negative prices. So just be careful. We're going to look closely at what happens next week. If we get, it's possible that we get a new high, but it's not entirely likely, because these trend lines really do provide zones of support and resistance. Sorry about the jumping around there. I was trying to get locked in on certain. So we could maybe get something that looks like maybe we get a box like this with a tail that actually makes higher prices, and then we look to the next week and we get a box that looks like this. Well, now we need to make a decision to step aside and let this play out to the downside, okay? And then once it's done, once it's played out to the downside, we start getting close to these previous lows. We want to see how the market behaves. Does it find support and reverse? If it does, we want to get back in because we're probably going to new recovery highs. If it doesn't, we want to stay on the sideline and let the train come barreling down the tracks. So hopefully everybody understands that. All right, I got a picture of crude oil up here. Actually, what I wanted to do is put a picture of gold up here. So let me put a picture of gold. Not that they're that far off, but so you got this long-term bull market into that 1923 area in 2011, and we've been pulling back ever since. Now, we broke this downtrend line as marked by these two yellow lines, and we've had pretty good rally, and we're starting to pull back. So I don't know. To me, I would have expected this to move up into this zone, but maybe it continues to pull back, like so, and then pulls into, this zone this way. But I think up here somewhere is probably where, gold will probably slow down and start to roll over. We've talked about this before, and I know it seems impossible, but nothing's impossible when it comes to the market, so you just have to know that. But once we get a pretty strong pull back or pull up, maybe into this 1531 area as marked by this red line, you're going to see gold over the next several years probably work its way down into this support area around 650. And it's going to be devastating. There's going to be people giving up. And this is where you want to be a long-term buyer of gold, because, again, if this is the first move and this is the first pullback off the first move, the next one is going to be, it's usually about 1.5 times or maybe twice as long as this move. So this move went from the low of 253 to 1923. That's a 1,700 point move. Double from wherever this stops would be 3,400 points, let's say, 3,000. So that means gold would be going to 3,600. And I know that sounds crazy at this point, but that's how the market moves. Now, it doesn't go straight there. It'll go and pull back and go and pull back, and just like it did here. I mean, look, this is a pretty good pullback right here from 1,021 down to 685. I mean, that's a huge loss of money of your investment if you're a long-term investor of gold. So this is the way these markets move, and all we're really trying to do is capture the larger picture so that we can pick a good place to get in gear with the trend. Same thing with oil. You got this longer move up. You got this kind of ABC correction going back, and I think we could see oil eventually down here at $16. But you can see right now oil is bouncing. Well, at this very moment it's pulling back, but it could be what you could be in the middle of is something that looks like, this, and then you get a pullback to, here, and then you get a run up to there, let's say, and then you get another pullback. Okay, so it could be something like that. So a pullback into this area would be a good place to buy oil, potentially. But then you want to know that, look, 55 or so is probably the limit. You want to step to the side, let oil come down to $16. Hopefully this is making sense to you guys, and certainly if you have any questions, you can use the comment section to question, and I will reply to those. I don't think there's any point in really going to NinjaTrader. Gold and silver are pretty much doing the same thing. We could look at the euro. Here's the euro. You can tell what I'm expecting the euro to do. Kind of come down here, find support, chop back up, and then roll over and make new lows. Now this is going to take many weeks, maybe 20 weeks or something like that. I mean, you can see how long it's taken just here. I mean, this is mid 2015, and we're just now here. Now, we've broken a little bit out of this, out of the bounds of this triangle, which is, again, these are zones. But I think you'll find that this will probably hold. Let's go to a daily. And if you wanted to short the euro in here somewhere, it'd probably be a good place to short the euro and ride it back down in here into this 107 area. Maybe a little bit under 107, depending on how long this takes. I mean, depending on where this trend line intersects this trend line. All right. So that's the euro US dollar. The dollar is very similar. Let's just take a look at that real quick. The Dixie. It's in this large consolidation. It looks like it's about done with this move here. So the next move would be for the dollar to rally somewhere along this line right here. Then eventually make another small pullback, and then rally to new recovery highs. So you can see the dollar up here around this 105, 106 area. Probably this is not quite high enough. I would say probably around here. And again, several weeks, maybe 6 months it might take to play out to get there. So keep an eye on that and play it the way you want to play it, but that's what we see there. The US dollar, Japanese dollar, or Japanese yen rather. I've got this triangle, but I'm not so sure this is a triangle. It could also be just a flag pattern, where you get a situation kind of like this, where the market's pulling back and within parallel lines, and then we get a bounce maybe up into here, and then another leg down. So you can see this. This is a great example of the difference between a correction, okay, and moving in the direction of the trend. If you look right here in this zone right here, well, it's too big to fit completely, but this right here, this is in the direction of the trend, this move right here, okay? And this is all counter trend move. The market has to take a break after you have a big movement in the direction of the trend. So, but what you need to know about that is that when you see a big move like this, if you get a consolidation like this, what you want to do is try to buy, in the top here, or, sell really along the top here, and then get the next move down. Because this is, a lot of times, this is just a consolidation area, or what's called a trend continuation pattern. So if the trend is in this direction and you get this, you want to be a seller up here somewhere and then get the next leg down. And this could be anywhere from 0.618 of this distance all the way to 100% of this distance in the next leg down. So, keep an eye on those. Those are great, great little trading tools. Here's another kind of continuation. This is called a flag. And if you see, if I take a Fibonacci extension here, and we just come down here to the low somewhere, and I come to the top. So what you would see, let me explain real quick where you would notice this, because in hindsight it's real easy to see, right? But where you would begin to notice this is you would see this move that's not very overlapping. Let's say at this point, okay? And what you're doing is you're watching for this pullback, and you're watching for it to end. So we get this pullback, it's coming back, it's coming. Now potentially it's ended here, right? So you could enter a trade right here, if you like, and see it's making its way. But sometimes that first. Now let's talk about this. Why did I say you could enter here? Well, you had this big strong pullback, and then you had what's almost looks like an inside day or a bullish harami. These always happen at the end of downtrends, or at the top of an uptrend, it would be a bearish harami. But so let's zoom in on this and just explain this a little bit further, because these are important trend reversal signals. And if you want to, gosh darn, I can't get this lined up here. There we go. Okay, so when you have a let's say a candle that looks like that, and then you get another candle that closes like that, and it's inside this one, the next candle, if the next candle's like this is an entry signal. Okay, that means you can enter right there. Okay, well that's almost what we have here, and what I said is you would enter right here, right? So the question then becomes, okay, so here's your risk. We've talked about this before. Here's your risk from here to just below here. So this amount of distance right here is your risk. And your reward, well, this is where you would do your Fibonacci extension. You would run your Fibonacci line up to here, down to the pullback point, and then you would trade to either where was I here? I lost my, here it is right here. So let me zoom in here. You would trade to either your target could be anywhere between this one and this one. It's just simply a preference. Now this one went much further, but a lot of times they won't go this far. They'll go to to this area right in here and then pull back. So, but that's still a really good trade, because you're talking about risk of from here to here and reward from here all the way up to here. I mean, it's big money. So that's how you can use your Fibonacci extension to try to pick a place to trade to, and then this is how you can notice these kinds of moves where the market takes off and then you get this pullback, and once it breaks out of this downtrend, then you want to trade in that direction. And so we've got kind of a similar situation here. We've got this move down, this consolidation. Well, you could take your Fibonacci extension to here and draw it out to 0.618 or 100% of the move and see what it comes up to. So let's just do that real quick, just to give you another example. Fibonacci extensions. So I'm going to come to the top here, down to where it stopped, and then over to any point on this line, you could have gotten in anywhere in here. So let's just take it to here, and then the target would be right in this area. So let's mark that target at this price level here. Let's call it 0.618. Okay. So what we're going to do is we would enter a trade and then trade down to this 0.618. Now, since it's moved quite a bit already, your risk is higher, right? Your risk has to be this distance here, but your reward is still much higher. So now you could trade to the 78.6 or the 100%. Those are just more aggressive trades. The market doesn't always move, consolidate, and move that far. So it's up to you. It's, you know, would be your system, your technique, but that's a good way to estimate, you know, how far the market could move. Of course, we could do the same thing in the S&P 500 or you know, any of the other markets that we look at. All right, everybody. So what I'm expecting next week? Let's just talk about it real quick. Before we wrap up. What are we looking to happen next week? Well, you could get a situation where the market gaps down a little bit on Monday, and then runs back up. Okay, like maybe not to even new highs. Maybe the highs are in. Doesn't have to make new highs, but you get something like that where the market runs up and closes the gap. And then, so this would be a bearish harami, okay? And then let's say the following week looks like that. So now you got a big bar, you got a open close inside that bar, and now you got a close below the harami signal candle. That would signal a downtrend. And then likely what happens right after that is these bars start getting bigger. Okay, they start getting longer, and the market starts to accelerate. So that's why it's very important to pay attention to these trend lines and pay attention to the price action at those trend lines, because it'll give you the greatest risk reward. I mean, if you got in here and your stop was here, well, there's your risk, but your reward is all the way down, you know, past 1875 here. It's way down here. So your reward is like 3, 4, 5 times your risk. So that's what trading is all about. That's what investing is all about. It's all about entering at a place where your risk is very small and your reward is much, much larger. And because you don't know what direction the market's going to go, and you don't know how far it's going to go. So all you can do is set up places where you enter where your risk is very small and known, and your reward is larger and unknown. So hopefully that helps. Well, you know, once the market, you know, once the downtrend becomes more definitive, a lot of this will become a little easier. The measurement techniques will be easier, and I think you'll really enjoy, you know, kind of not outwitting the market, because it's not about that. You'll enjoy, you know, putting your 401k in a position to make money, and then taking your 401k out of the market when, you know, the risk is higher, and you'll see your 401k grow much larger in that case. All right, everybody, that is it for this week. Really want to thank you for coming in this week and spending some time in the YouTube, and we will see you next week. Take care, everybody. Bye-bye.